Welcome back, everyone. Time for a Patreon exclusive. I just want to do a little late to midweek checkup here, see how you're all doing. Hopefully, you're all doing great. Hopefully, things are going well. Your portfolios are doing okay. We have a little bit of turbulence in the market, but I don't think that's much of a concern. Unless you're invested in a very select few companies that are getting hit particularly hard, the overall markets are doing okay today. They're down 1% to even 0.5%. So not a big day. I did come out with a video yesterday that was on the bubble that Bank of America, they put out a notice to their clients about a big .com like bubble. And we always hear these stories. They're always a little bit exaggerated is what it feels like because they're so frequently wrong. But I felt like this one wasn't really clickbait because there's a lot of meat to it. We went through a lot of slides, a lot of data, a lot of indicators and contraindicators, things that give you a little bit more perspective. One thing I like about that video that I did yesterday is I like feeling like there's some grounded reality to the market in terms of commentary. Right now, I feel like there is euphoria in this market. There is a buying frenzy with a huge quintile of investors. Investors bidding up companies like Robinhood and Hims and Palantir to the moon. They're just buying it and buying it. And when I see that type of behavior go on and it gets amplified over time, that makes me want to just pause for a bit, take a breather with my buys and consider what's going on. I don't like it when companies get bid up and they pull forward more and more of their earnings. That's not my ideal situation. I don't like it for any of my companies. In fact, even companies like Costco, that they have too much of their earnings pulled forward. I'd rather them grow a little bit slower and steadier so that they're almost always intrinsically fair valued or undervalued. That's the ideal situation. When I see this type of situation where we have so many companies getting bid up so fast, when there's so much appetite in the market for the next double, the next triple, it's not good enough to have a 15% compounded return. We need a double every year. That is greed. That's where pigs go to get slaughtered. That's when people lose focus of fundamentals, free cash flow per share growth, earnings, dividends, dilution, and buybacks, and they just focus on whatever they think will get ahead of the crowd. And although you can navigate that territory, and there's some people that may have success doing it, that's not what I'm about. That's not what this channel's about. I invest in companies that I think are fundamentally sound. They're rationally valued, and they'll have fair, but I'd say strong compounding over the future. Doubling over every 5 to 7 years, not every year. And there's a big difference between the two. Underwriting 15% per year compounded growth is a lot different than 100% per year. So I put out these videos not to try to scare people, but just to give a warning that my perspective right now is the market has entered into this phase of feverish, euphoric buying, and I don't think it's that healthy. So I'm being a little bit more disciplined. I'm trying to hold off from buying stocks left and right. I want to look for when there's a little bit more bearish sentiment, just a bit more skepticism in the market until real opportunities open up. I think there are still opportunities right now. There's obviously companies that I'm still adding to, but they're the familiar names like S&P Global, ones that I think are still decent valuations right now. But having said that, let's go ahead and jump into the Ask Me Anything. This time we have a number of questions to go through, and I'll try to go through where we went to last time and then go back to even the older questions. So I'll try to get through as many as I can. Let's go ahead and jump in. And by the way, we have Texas Roadhouse's earnings in 30 minutes. So maybe if those come out by the end of this, I'll comment on those as well. But let's go ahead and jump in here. Hey, Joseph. Gennaro here? I don't know how to pronounce your name. You'll have to tell me how to pronounce it. Here from the Netherlands. Love the show and Qualtrim. I'm glad you're here from the Netherlands. That's awesome. In your show, you talk about why you like your companies to grow revenue by 10% a year. Correct me if I'm wrong. That's about correct. I'd say anywhere above 8%. I like them to grow. I have a position in NN Group. This is a big insurance company in the Netherlands, but the revenue is declining 3 years in a row. The people here say that the revenue is not important for an insurance company. Want to know what you think? Well, I certainly disagree with that. If you look up insurance companies from Geico to Progressive, any large insurance company, they should be growing at least with inflation every year, at least over a 3-year rolling basis. So having declining revenue over 3 years, I would have to look into the reasons why and see if it's some outlier event, if it's some unlikely to reoccur event. Because to me, revenue declining for 3 years is a huge red flag, even in insurance. Insurance, you should be writing bigger policies, you should be getting more and more customers, you should be cross-selling them. So if you're insuring their car, you insure their home, you insure their ATVs and four-wheelers and RVs and boats, right? You want to cross-sell insurances, you should give them life insurance. You should try to insure all these different things and cross-sell, and that grows your revenue. So if the revenue is shrinking, to me, that's just a huge red flag. I'd need some very good explanation of why that's going on. MZG says, what's a good price to get into stocks like Netflix, Costco, Visa, MasterCard, S&P Global if you missed the bus on these a few years ago? Well, there's a couple ways to look at this. Okay, so if you want a specific number to anchor to, like a number where if it goes below this price, you'll buy. If it goes above that price, you don't buy anymore. That's fine. That's a clearly defined number. I think is a good thing as long as you don't anchor to it too hard and you can adapt it through different environments. But I don't mind if you go through a clearly defined number. In the end of 2 weeks, I'd say a week or two, we're going to have a new tool in Qualtrim that is a simplified discounted cash flow calculator. I know when you say DCF calculators, people, they roll their eyes. It seems like it's going to be some complex Excel spreadsheet. We've all seen them. Everybody has their own personal flavor with a million different things. There's all these different terms, terminal value, exit multiples, these things that are somewhat vague and ambiguous. This is not that. This will be super straightforward. It's like 6 different inputs. You can make rational assumptions about a stock and get an immediate value of what the return will be like based on today's price and what you need to buy the stock to get the return you're looking for. So you'll be able to say, I want to get a 15% compounded return for the next 5 years. What price do I need to pay for the stock based on these simple assumptions? And it will tell you that price. So that's going to be in a couple of weeks. You'll be able to get definitive prices. Now, in terms of just offhand, vaguely, the way that I think of valuing stocks is more in the range of ranges. I simply think that there's a fuzzy line, not a strict line, but a fuzzy line of fair value. And then there's this fuzzy line of overvalued or richly valued or full value. And then there's a fuzzy line of undervalued. Now, in terms of those 3 lines, I think Netflix is still in the category of fairly valued to undervalued. It's somewhere in that category. On the metrics of next year's multiples and this year's free cash flow, of course it looks a little expensive, but my thoughts on Netflix is I'm going to hold this company for the next 20 years, and I assume that the prosperity of the company, the overall financial prosperity, the moat of it, the relevance of it, the expansion, the opportunities, the total addressable market, the predictability of it, I think it will be multiples bigger than it is now. And I think it'll be able to return a lot of cash back to the shareholders. I also think it has one of the best management teams in the business. These co-CEOs are really executing. So I really like where it is right now. And I think even today, if investors bought it today, I think they'll get a above market return over the next 10 years. Now, it would have been easier if you bought it a couple years ago. Obviously, that's when you got really easy returns. It'll be more hard fought returns going forward, but I still think it will beat the market. In terms of the range for Costco, I think that one's in more of the range of being very fully valued. Investors have very strong positive sentiment on it. In terms of the trading range of Costco, it's at the higher end of the range. It usually trades between a 33 forward PE and a 50. Right now it's at a 50. So I don't I'll hold this stock at this range. I don't want to kind of begrudgingly, I don't want to sell it right now. But I also do not want to add to the position right now. I feel like there has to be better opportunities to add. Or if anything, there's better stocks to add to right now. And if Costco does go up to a 60 PE, to a 70, I will be selling off chunks of my position. I love Costco, super bullish on it. But no stock is worth an infinite price. Even the best stocks, even ones like Coca-Cola, became overvalued in the dot-com bubble. So as good as Costco is, there is a price that's too much to pay. Right now, I think it's getting up there. And if it goes much higher, I think it's there. I think I just need to take some gains in it and move my money elsewhere and look for a better opportunity. So Costco is one that I think is in that fully valued. I think Visa is fair to undervalued. I think MasterCard is fair to undervalued. I think S&P Global is undervalued. I think it will outperform the market meaningfully over the next 5 years. That's my assessment, not recommendations. There's no guarantees with any of this. I have my money invested that way. I'm willing to lose money on these bets if they go wrong, and I own that, so you have to make that decision for yourself. Hi, Joseph. What do you think about NICE going down after earnings? Do you think NICE stock is undervalued now? So I have a buddy that works at NICE. He's actually an accountant. He's super smart. He's like one of the head accountants at NICE. So I don't buy the stock simply because of that relationship. I feel like it's too close. If he knows all of the financials of the company all the time, he helps prepare the quarterly reports, he works with auditors and everything, so he knows everything in advance. And so I'm not going to buy the stock no matter what happens to it, just because I don't want to have this weird relationship where he's kind of guarded around what he can talk about with work and all of that. But on a general level, what he's described as NICE is a company that is continually undervalued because investors are predicting that customer service as a whole is going to be replaced by agents. Think of the stuff that Salesforce is selling. Agentforce, that's going to reduce customer service. NICE is a company that sells software for customer service phones. So it's like digital phone service. But one thing he points out that a lot of people don't factor in is that a ton of NICE's revenue is not just from customer service, it's from companies using cloud phone systems. They're not customer service agents, they're just companies that use phone systems that are cloud-based. So a lot of their revenue isn't even susceptible to being replaced by customer service. So I don't know why the stock is down. I assume it's down because of poor guidance or some number that went a little low. But I think that NICE probably is a good bet. I think it's likely undervalued. It's just so difficult to say. The industry that it's in is under a lot of changes and dynamics and disruption. But NICE is, I think, more solid and more diversified, and the revenue streams are a little bit less disruptible than what investors are pricing in, because the stock is very cheap based on the multiples. Could you see yourself ever investing in TSMC if they diversified enough away from their production from Taiwan, or would you still consider it too politically risky? Sure, I mean, between TSMC and a company like ASML, I'd rather just pick ASML. I think it's very similar, but it's even a little bit more solidified and removed from the politics of it. I don't want too much exposure to those type of small risk factors. And this is something that Warren Buffett has been good at avoiding. There's a very small chance that China invades Taiwan and takes over TSMC. There's a non-zero chance of that happening. You might think that's crazy. It'd be super aggressive from China. It might cause a war. I happen to believe that the U.S. would defend that militarily, because I think that Taiwan and the industry there is more important strategically to the U.S. than most NATO countries. So even though the U.S. has this big alliance with all these different countries, if you look at how strategically important Taiwan is, and these chips that they make at these facilities are, what is more important than that? Those are the things that power all of our modern civilization. To have China control that would be it would be such a strategic loss for the U.S. So even though we don't have like an official alliance, I think the U.S. would get involved militarily if there was an invasion. And, that's the risk there. Now, Warren Buffett, I believe, sold because of that risk. He doesn't like it even if it's 1 or 2%, because he believes if there's a 1% chance of something happening every year, eventually it could happen. It's the same reason Warren Buffett does everything to protect his gains at all costs. So he's not going to invest in this stuff even if it has a small chance of failure. In my case, I'm okay having one company, ASML, that has exposure to this type of risk, but I don't want to own the entire supply chain. So I'm going to try to pick and choose what I want to own. I think ASML is a really good bet in the mix of it. Hi, Joseph. Wondering what your opinion is on investing in electricity/energy sector. And if you have any opinion on Iberdrola or the other electricity renewable giants. Obviously, no. I don't even know how to pronounce them. So Not much of an opinion there. I have not looked much into the energy sector. I think the energy sector is becoming a bit of a downstream or maybe upstream industry with it's more detached to simply Nvidia. It's too detached to Nvidia and AWS. Basically, the energy sector is now becoming like the capex of Microsoft and Amazon and Meta and Google. If they spend a lot on servers, then the electricity energy sector I think will do well. If they don't, it's going to get hurt. I'd rather just own the big companies that are creating all the demand for energy than these companies that are reliant on them. Sorry if this has been asked before. I'm relatively new here. Would love to hear your thoughts on BlackRock. Appreciate what you're doing. That's fine. I think it has been asked before, maybe a while ago. But BlackRock is a company. You'll notice I don't own many money managers. So I have a natural tendency to avoid investing money into groups where they take your money and then they pick what to invest in. Now, that is what CEOs do. So Andy Jassy will take investors' money or take the revenue from Amazon, and he will act as an investor and put money into that. But that's under an umbrella of an already shaped vehicle. Specifically, Amazon's a curated thing. The same with any other company. Like Texas Roadhouse takes investors' money, or they take the money from their customers and they choose different investments to make, but those are very predictable investments. They're making investments in new capex for new restaurants. Costco does that for new locations, for new warehouses. Booking Holdings does that for more advertisements to create more demand for the hotels, so on and so forth. With BlackRock, I think what they invest in is less predictable. They have more free reign of what they do with it. It's more determined by the managers. It's a little bit like investing with Bruce Flatt and he takes your money and does it, or investing with Bill Ackman and he takes your money and just buys investments with it. And in terms of that, I'd rather just be in control of the investment. I feel like I'm pretty good at it. I don't think that there's someone at BlackRock that necessarily can just take the money and multiply it way faster than I can. So if I'm spending time doing research on individual stocks and I have a good knowledge of the type of companies I want to own more of, I'd rather just own more of those companies instead of handing it over to something like BlackRock where they decide what to do with the money. Hey, Joseph, I'm managing a large portfolio for my family and have to manage the risk for people in various stages of life. My dad has just retired and my brother and I are still in school. My current allocation goal is to have about 40% cash/fixed income, 40% in the market exposure, VOO, 20% in individual equities. My question has to do with the cash and fixed income portion. Currently, money market funds are yielding 4.2%, but the CC strat, ETFs like XYLD and JEPI and JEPQ are yielding between 6 to 9%. The main bear cases I have heard from people is that there's limits to your upside. But if I have it as part of my cash/fixed income allocation, I don't really care what NAV is doing. Once that I found particularly interesting was BINC, which is an actively managed fund by an investor I like a lot. What are your thoughts on incorporating sometimes these high fees but high yielding ETFs in my own fixed income allocation? Generally against them. Because the reason, I would look at their overall performance. So drag up a chart that, a back tester that incorporates the dividends being reinvested and just look at the performance over the past 5 years. I think they have too much risk for what they're providing. And I think in this environment, you're better off just investing in a money market fund that has essentially no risk and gets very similar yield. You're getting a 2% yield while taking on no risk, as opposed to something like JEPI, you get slightly more yield, but you're taking on covered call option, equity risk, market decline risk. It's just not as good, especially if your goal here is to protect. If your goal is to make gains and invest in equities and growth companies, if your goal is to protect your money and downside, then put it in money market or treasuries. I think the JEPI, JEPQ, and XYLD fits in this in-between area where it doesn't accomplish either of those goals that well. So I don't really like them that much. I've kind of changed my opinion on them over time. I think there's just better things that create alpha and better opportunities to protect the downside. In terms of the rest of it, I think you're doing a good job. You're thinking about risk and reward. Obviously, when people ask me, I get asked this all the time. Joseph, what should I invest in, right? Like, should I buy this ETF or this ETF? And I tell them, I can't tell you that. This is the type of question that a financial advisor would answer, because they'd have to look at your age, your income, your risk tolerance, your timeline of investment, if you're able to stomach volatility, and on and on and on. You tailor your portfolio to a lot of factors around your personal life. So there's no one ETF fits all. In my case, I feel like I have a long investment horizon. I feel like I can weather downstorms and volatility very well. So I go for large cap growth companies that I consider to be compounding machines that I think will have a level of volatility that maybe some people aren't happy with, but I know will do likely really well over a 10, 20 year period. So that's geared towards me. That's what I'm showing on YouTube, but it's not appropriate for everyone. So I like how you're tailoring it to your different situations. Is there any value in stock splits? Booking is currently over $5,000 per share. Amazon and Google have done stock splits in recent years. Do stock splits with lower cost per share do better than higher price shares? Psychologically, does it feel better for retail investors to buy more whole shares at lower prices? So in terms of stock splits, there are some mechanical, there's no fundamental differences. Okay. So fundamental meaning, does it change the company, the earnings, anything like that? No fundamental, but there are some mechanical differences. Mechanical differences meaning that it's more liquid. It's just easier to buy and sell. You can disperse it in part of employees' pay easier. Because what if you're paying an employee in stock and they earned, $2,100 worth of stock? Well, you either give them $5,000 because that's one share, or nothing. So that makes it very difficult. You'd have to do like fractional shares, and only certain brokerages handle that. So there's mechanical differences between low share prices and high share prices. High share prices are less liquid. There's less liquidity in the stock itself, so there's a little bit more volatility in some cases. I think there's also benefits of it. You get shareholders that I think are a little bit like higher income. They hold the stock longer. They're not in and out of it as much. So in essence, it kind of removes some liquidity, which can make the stock feel a little bit more stable. But I think overall, the biggest issue with high share prices is how you compensate employees with stock. It's just harder to do at that point. So that's the main argument against high share price and against not doing stock splits. In terms of psychological, I do think there's lots of differences. Investors like buying and buying companies and feeling like they're owning a lot of shares. When you can only own one share of a company, even if you put $5,000 into it, it's like, I got one share, it just doesn't feel like as much. As opposed to if you had 50 shares of it, right? That would feel so much better, just saying I have 50 shares of this company. So I think there is a psychological aspect to it as well. Over the long term, I don't think that makes a difference. So I have no problem with Booking keeping their share price how it is. I have no problem with them doing a stock split. I don't think in the long term it really affects much either way. Hi, Joseph. I'm 24 years old and have a good amount of money invested. I also have a good chunk of cash for a down payment on a house, but I don't think I will be buying for at least 3 years. Would you recommend putting some or all of that cash into high quality companies, or keep it in the high yield savings account for a down payment and market downturn? Love the content. That's difficult. So it's totally dependent on your situation. You have to make this decision yourself. I would have some money in savings at any stage. I just think it brings a lot of leisure in life to have a little bit of savings. Like, it's just less stressful to have some savings. But beyond that, I feel like you should have your money in some asset or another. Everything's inflating in the world all the time. There's products being made, there's prices being increased, there's taxes and all this type of stuff. And one thing we have that really hedges against that are assets. Assets like homes that have high replacement values that go up over time. Assets like stocks, they raise prices and they generate more revenue every year. They can offset the cost of inflation. So I feel like just having your money in savings, you get that little 3 or 4%, but I'd rather have my money in assets one way or another. If it's not in a home, it's in a stock. If it's not in a stock, I'm saving for a house. I think if you put it all in stocks, save up for a few years, there's a couple situations. The stock market falls. That's a bummer. But if the housing market falls at the same time, then it's sixes. So, it's only a problem if the stock market falls while the housing market goes up. That could happen, but that in case, I just keep it in stocks. So my choice, Jackman, if it was me, I would have my money in cash producing assets or in an equity of a home or something that is a productive asset. And I consider a home a productive asset because if you're not in there saving on rent, someone else is in there paying rent. That's productivity made or productivity saved. So either way, I'd have it in productive assets. I don't consider cash a productive asset. Hey, Joseph, I know you're not a fan of banks because their success is mostly dependent upon repayment of debt they have loaned out. But I'd love to hear your opinion on the COF and DFS merger, which is seeming more and more likely to get pushed through. How do you think it will affect the other banks, credit card companies, and even payment processing companies? Also, any thoughts on just regular consumers? I haven't seen, from my viewpoint, I haven't seen a lot of feathers being ruffled by this. I haven't seen really any credit card companies or anyone else be too concerned about it. I don't think that these mergers really change anything dynamically. I don't. Some people do, but we'll see. Most companies just adapt right around them. In terms of why I don't invest in banks, it's not just because they rely on repaying loans, but it's also that they're levered out. And in many cases, I think it's difficult to underwrite how much risk they're actually taking. It's just difficult to predict the level of risk. And in most cases, people that really understand banks well, I make fun of Terry Smith a little bit here and there, but he's a bank analyst. That's how he made his career. And he says the more you learn about banks, the less you want to own them. So that's telling. Now, that was a long time ago. I do think most banks have become a lot better institutions, have focused more on financial services, credit card fees, and things that are more reliable than just margin loans. But overall, it's not an industry that I find that appealing. It's kind of in the same vanity as insurance companies. You're just, margining, taking money out, lending it to others, pooling it together. Very difficult to see the amount of risk being taken. With insurance companies, you have to underwrite the risk of claims. If there's some big earthquake or something, is the insurance company going to go under? With banks, if there's some financial crisis, is it going to go under? It's so much easier to just look at a company. I can look at a company and go, okay, how much long-term debt do they have? What are their expenses look like? What are their capital leases look like? And what does their EBITDA look like year over year? And that's way easier for me to actually figure out what the risk is that they're taking. Hi, Joseph. The current administration seems to have a focus on energy. Data centers are power hungry. Any opinion on nuclear power companies? Mostly currently unprofitable, Lou and Okla and others. I have not looked into this much, but it is very intriguing. Like I said in the previous comment, it's true. The energy companies are now being combined with data centers. So if you're investing in like NVIDIA, if you're investing in Microsoft, the data needs, the data requirements to run these massive GPU farms, it's so intense that they need entire power plants just to run one GPU cluster. So it's really incredible what's going on here, to the point where they're no longer GPU constrained, they're power constrained. So now we have too many GPUs that are too high powered, but we need more energy, or we need more efficient GPUs that can run on the same amount of power, but process more, do more processing per power, whatever power unit you're using. So right now, it really is like data centers have the new what am I trying to say? The new funnel, the new bottleneck. That's the word. Bottleneck is the power companies. So I think there's a story here. I make predictable investments. It's hard for me to speculate on which power company is going to benefit from this. It seems unlikely I'm going to be able to have some edge on that. Again, I feel comfortable just knowing which tech companies are going to benefit from all this AI spend. So I go with the big cloud computing companies. I think they're the most predictable, obvious winner amongst this whole question. But yeah, I definitely think there's money to be made here. If someone can figure out which companies are likely going to be the ones that power supply all this AI energy, I think nuclear power is going to be the obvious solution. Once people get over the concerns of another reoccurrence of a problem with a nuclear power plant, it's going to be the power of the future. I don't see it as being windmills. I don't think it's going to be windmills. I think solar is pretty good. I think nuclear is the best. If you can do it safely, if you can cross all the red tape, I think it's probably the best one. Cuz says, are you religious or spiritual? Yeah, I'm religious and spiritual. I think, well, to preface, if you're agnostic, you don't know if there's a God or whatever, or if you're atheist and you don't believe in God, that's completely fine. I know that statistically, we have people of every viewpoint, every religion in this thing. We got people from every corner of the earth on this Discord. It's absolutely crazy. Seriously. Philippines, East Asia, India, all throughout Europe, Canada, South America. We have people from everywhere. So I'm sure we have people that are agnostic and they just don't know, don't concern themselves, or atheist and you don't believe in God for whatever reason. If that's your experience and your viewpoint, I don't look at you any differently. It's not something that I treat anyone any differently. I don't think that your views are bad or anything like that. But me personally, I believe in God. I think there's a God up there. I think he loves all of us. He loves all of his children. And I think there's a heavenly mother. There's got to be a mom up there that cares about us as well. But that's the viewpoint I look at it from. If you want to know my summarized beliefs, I think there's I think there's a God. I think he loves all of his children. All of us are here. We all have different strengths and weaknesses and experiences. We all come in different shapes and sizes and colors. And I really feel like we should, as we go through life, we should try to treat people well. Just lift up other people. There's a certain viewpoint, I think, that when I look back on my life, I want to make sure when people run into me and they come across my channel, they come across me in person, that was a positive impact on their life. Because I do think ultimately there is going to be some cosmic justice about how we treated other people. But I do believe in a very loving God. I think he loves his children. I view it the same type of way. I have kids and I love them to death. I want the best for them. I feel like there's someone up there that feels the same way about us. Hey, what was the question unanswered in the recent AMA? Why was this question unanswered in the recent AMA? Was it too old of a question? Let's go back. Let's go way back here. We're zooming back. That's not why I don't answer questions. It's literally just because I cut down on time. Let me go back and answer this one. Okay. Hello, Carlson. I have a two-parter for you. One, what do you think of Novo Nordisk? It seems to have all the great elements of a compounder that you look for: great growth, management, moat, etc. The other question is, why don't you own Taiwan Semiconductor? Another question about TSM. I would argue the growth prospects and capital allocation is superior to ASML. The only real concern is invasion risk. We've already gone over the invasion risk. It's there. It's a non-zero chance, but boy, would that be a problem. That if China invades Taiwan, that's not just a problem for ASML. It's not just a problem for TSM. That is global powers butting heads. You know President Trump would not like that. Even Democrats, even Nancy Pelosi said, of course we would intervene if China decided to invade Taiwan. So you got people on both sides of the aisle that are stating the U.S. will get involved if that happens. I think China is going to be very tactical about that. I think if they were going to do it, they would have already done it. But who knows? It's hard to read the minds of China and their government and what they're deciding to do. In terms of Novo Nordisk, I need to look at this one. It is a great company by the fundamentals. I've looked at it just on a surface level, but I need to spend a weekend looking over it. That's one I just haven't spent enough time on. So maybe I'll jump into this stock channel after this. Now, let's go ahead and take a look here. We just had Texas Roadhouse report their earnings. Let me see if we have the numbers in the chat. Let me take a look here. I'm asking if anybody in the chat has Texas Roadhouse's numbers. We'll see if we got them. I think the stock, maybe we'll just pull up the quarterly results. Okay. They're saying it's in the Texas Roadhouse channel. I'm going to go ahead and jump into this. I thought it would be good to just cover this in it. All right. Okay, let's take a look at how the stock is reacting. You know, Texas Roadhouse is a smaller company, so it's kind of hard to gauge what's going on after hours. The kind of smaller, lower liquidity companies, we don't have a lot here. It's down 1%. Down 1% after hours. Not a big drop. Okay, so that's good. I guess it's not too bad. Let's go ahead and take a look at the press release here, and I'll give you some initial reaction to it. All right. Texas Roadhouse. This is 2024 Q4, so we're on the right quarter here. Let's go ahead and take a look. We'll read through this together. Texas Roadhouse announces fourth quarter 2024 results. Increases quarterly dividend by 11%. Just 11% dividend bump. Approved stock repurchase program of $500 million. I love this company. I love it for so many different reasons. I'll go into that later. Let me just go through this report, but I'll go through why I love this company. The financial results of the fourth quarter and fiscal year ended December 31st. Total revenue is, okay, fourth quarter, total revenue is up 23%. Is that right? That fiscal year ended. So the revenue grew 23% year over year on the quarter, 16% annual revenue growth year over year for 2024. The income from operations was up 65%, net income up 59.9%, diluted earnings per share up 60.1%. Why is the stock down at all? See, this is what, you know, I look at companies like this, and these are extremely strong numbers. Yeah, the chat's saying that they're going out and celebrating with a steak tonight. I would. This is insanely. This company, I love it because it grows so fast. It's such a fast-growing company. It's growing faster than Intuit, S&P Global, Moody's, Amazon, Apple, Google. Texas Roadhouse is growing faster than all of them. And it's at a lower valuation than most of them. And it's the problem is it's lower margin, but they operate a low margin business with such precision that they're still just executing. So they get a little bit of a lower rating because of the low margin of the company. But I love seeing these numbers they're posting, just consistent quarter of execution. I looked at the app. One thing I do with Texas Roadhouse is every weekend I'll just kind of look at the app. I'll go to different area codes and I'll type that I'm a party for 4 at different locations across the country, California, Texas, you know, in Vegas and Utah, all over the place. And I'll just see hour and a half wait, 50-minute wait, 90-minute wait. And it's amazing to see that, to see every location across the country. I'll pick 10 or 15 of them. It's like I get a nice little sampling myself, and the wait times are always excellent. And I really love seeing that. Yeah, let's take a look here. Okay, so we have a little bit more of a summary here. Let me read this off for a second. Texas Roadhouse has reported earnings Q4 of 2024. Total revenue is $1.44 billion, up 23.5% year over year. The estimate was 1.44, so they beat estimates by $300 million. Net income, $115.8 million, up 59% year over year. Diluted earnings per share, 1.73, up 60% year over year. CEO Jerry Morgan said we ended 2024 on an incredible note, which was the highlighted by fourth quarter and the full year traffic growth at all 3 of our brands. These results are a credit to our operators who continue to create an environment where roadies, so they call their staff, they're the roadies, they want to work and guests want to dine. Restaurant and other sales grew 23.5%. Comparable restaurant sales were up 7.7%. Average weekly sales were around $153,800 $800 versus $141,000. When I was investing in Texas Roadhouse, I think the average weekly sales were like 90,000. Now they're 153,000. It's insane what they're doing. They've taken so much market share from other companies. To-go sales were 20,000 per week. That's over $1 million a year from just to-go sales. And by the way, if you haven't been to Texas Roadhouses to go, just try it out. That you go on the app, you order your meal, you swing around the back of the restaurant. They have a big double window that you just walk up to and get your food, and they load you up. I mean, you get rolls, it's nice packaging, it feels quality, the packaging. It's a great experience. People that do the to-go ordering end up doing it more and more because they feel like they're getting such good value. It's so convenient. The restaurant margins were 17% versus 15.3% of last year. Income from operations, $138.6 million versus plus 65%. Operating margins, 9.6% versus 7.2% of last year. Cash and equivalents, $245 million versus $104 million of last year. That's why they're doing the buybacks. They have too much cash. Sitting on $240 million of cash, that's too much cash. Business highlights, they opened nine company restaurants and 5 franchise restaurants. They completed acquisitions of 13 franchise restaurants for $78 million in early 2025. That's one of the things they do that's so smart. They have franchises start different restaurants. They see which ones are doing okay, and then they just purchase those ones from the franchise owners. The franchise owners like it. They get paid out money. They can go start a new franchise with a different brand. And Texas Roadhouse gets a nice restaurant that's already running really well. Works out really good for both parties. Board approved quarterly dividend increase of 11% to 68 cents per share. The authorized new $500 million stock repurchase program. In the future outlook, comparable restaurant sales 2.9% in the first 7 weeks of Q1 of 2025. They are planning a 1.4% menu price increase in early April, expecting 5% store week growth in 2025, projecting commodity cost inflation of 3 to 4%, targeting $400 million in capital expenditures in 2025. Their CapEx is sure going up because the restaurants, construction and bump outs and renewing some of the old restaurants is expensive. So they have that going on as well. Overall, a super solid quarter from a great company. They are increasing prices steadily, like 1 to 3% per year. I've noticed the prices go up at Texas Roadhouse, but it's still such a good value proposition. It's still underneath their benchmark. Any other steakhouse, typically they're more expensive and they're not as fun. That's the scenario. I know some people don't like the Texas Roadhouse yeehaws and the noise. It can get a little bit noisy, but that's part of the fun. People want to go there and have a fun, rowdy night out at Texas Roadhouse. I think it adds to the ambiance. It has its own little own feel. So I like it. I like everything from this. Solid report all around. I'll have to listen to the earnings call, look it over a time or two. I do that with every company I invest in. I don't just look over the earnings report once. I'll look at the numbers once they're in Qualtrim. I'll update the KPIs. We'll be going over this one a little bit more, but initial impressions, I think it's time to celebrate. It's time to go get a steak, celebrate Texas Roadhouse's earnings. That's going to be it for this one. Hope you all enjoyed. See you in the next one.